It's very important to not be a gold bug and just look at gold and silver. If you do, you miss the point, especially now because these other icebergs that are moving around and bumping into each other have consequences for the other asset category, sometimes negative, sometimes positive. In the case of gold, these impacts are positive. Suddenly, the government debt iceberg is in question. The stock market is topping. It's a nuclear event. So I'm not sure where gold's going, but I know silver's going to catch up to it. I had been saying for many months, based on a whole variety of reasons, fundamental, technical, valuation, that silver is likely to go to 300 to 500. I don't know where it's going. I think that could be on the lower end of where it might go. We'd have to go to 8,000 to 9,000 gold just to match the relative dimension of the prior two bull markets, which were under less dramatic fundamental situations, enough to where that only thing that makes him smile, the average guy with his retirement account, is the fact that his stock portfolio is up. Retirement account. You take 20-30% off that and suddenly he frowns. He and his wife frown. Emotion comes into play. Panic comes into play.
Right now, we are seeing major breakages throughout different markets. What is your time frame on this? Like, if we look to the end of the year, where do you anticipate metals to be?
I think once you get high enough in this rally, now see, right now the miners came back, pretty close to their highs. The February highs. So, if gold did what, for instance, GDX just did, gold right now, instead of being 4,600, it'd be more like 5,200 or something. Okay. But there's a point at which the doubters, and they will sell on the way up, there's no doubt, but we argue that this rally is different. It will sustain. Yes, there will be pullbacks because the doubters will come in here and there, but that there will be a point at which even the dummies who don't realize the massive fundamental driver and technicals that are underneath this market, the monetary metals, will realize, oh gosh, I was wrong. This wasn't a bull market top. It was a major teasing corrective pullback, most of which occurred in a day and a half, actually. And at that point, then you'll suddenly see acceleration in gold and silver to the upside that will look like wet bars of soap being squeezed. Even more so than what we saw in that initial breakout that silver rendered late last year on price, where it finally came through after 50 years of being caught in a range, popped through 50, like in November. And by so December, and later, like 2 months later, it was 120. That was its first, I'm out of here statement.
The danger is not the pullback. It is selling before a breakout changes character. Michael Oliver notes that miners remain undervalued relative to gold, while silver previously escaped a decades-long range with explosive speed. That suggests volatility may be shaking out doubters rather than ending the trend. For investors, waiting for perfect confirmation could mean buying after repricing has already occurred. Next, Michael Oliver exposes why the next acceleration could arrive far faster than expected.
That wasn't the end of something. That was its initial statement of, gosh, I'm finally broken free, okay? Yes, it pulled back hard, but that was not the end of something. That was the statement of the beginning of something. When you get out of this congestion zone, we have ceased to have a target anymore. I had been saying for many months, based on a whole variety of reasons, fundamental, technical, valuation, that silver is likely to go to 300 to 500. I now lift that. I don't know where it's going. I think that could be on the lower end of where it might go. Also, I restate the old reality that gold has twice in the past, since it was legalized by the government. 1976 to 1980 was a bull market that was eightfold. Low to high. 2002 to 2011 was a bull market that was eightfold, from bear market low to bull market high. Our bear market low was 1,050, so we're 4,600, so we're more than fourfold. We're not eightfold. We'd have to go to 8,000 to 9,000 gold just to match the relative dimension of the prior two bull markets, which were under less dramatic fundamental situations. And I suspect gold is not going to stop at a ho-hum again eightfold move. These events that are going on now are far different than they were at those two bull markets. We're talking government, implosion of their paper, of their debt. It's it's a nuclear event. So I'm not sure where gold's going, but I know silver's going to catch up to it. And if silver merely caught up in valuation to, let's say, where it was back in 1980 when it first hit $50, remained capped there for 50 years, but it hit $50, the spread between silver and gold was 6.5%. Divide 1 ounce of silver into 1 ounce of gold. Right now, the spread of silver versus gold is 1.6%.
Gold at $8,000 to $9,000 would merely match the scale of earlier major bull markets, not necessarily exceed them. According to Michael Oliver, today's government debt stress makes those historical comparisons potentially conservative. The harder question is what happens when confidence in paper assets deteriorates across currencies and sovereign debt. Investors could be anchoring to targets that no longer fit. Next, Michael Oliver unravels why silver's valuation gap may signal far more upside than conventional targets suggest.
Off the page cheap compared to then. Just like the miners are off the page cheap compared to gold right now. I think that's going to end, and with an abrupt change. And so what's on the other side of this congestion, I think, is going to be verticality. And I think a lot of it will occur literally within a couple handfuls of months. That's all. Maybe one handful of months. Because there'll be an awareness that, oops, I didn't realize that. Financial problems. Government financial problems. And there not being a viable alternative.
Well, it should be quite interesting to continue to track this with you, Michael. If our viewers are interested in learning more and getting the momentum perspective rather than just someone who analyzes price, they can go to olivermsa.com and sign up for your report. Can you tell us a bit about that?
Yeah, we cover all 4 major asset categories, commodities, monetary metals, especially stock markets, not just U.S., but others, bond markets, and foreign exchange. And so, and it's very important to not be a gold bug and just look at gold and silver. If you do, you miss the point, especially now because these other icebergs that are moving around and bumping into each other have consequences for the other asset category, sometimes negative, sometimes positive. In the case of gold, these impacts are positive. Suddenly, the government debt iceberg is in question. The stock market is topping. And I think that by the end of this year, you will know that big time. I think the transition, for example, in the stock market is likely to begin now, but to show to the public, probably in the fourth quarter, that it's really headed down. I don't mean crash necessarily, but, oh my goodness, it's 25% off the high. Oh my, 30% off the high. Not necessarily overnight, but, enough to where that only thing that makes him smile, the average guy with his retirement account, is the fact that his stock portfolio is up.
A quiet rotation can become expensive when investors notice it after the repricing. What Michael Oliver is highlighting is the connection between government debt, equities, bonds, currencies, and monetary metals, rather than viewing gold in isolation. If stocks fall 25 to 30%, the wealth effect could rapidly change investor behavior and redirect capital toward perceived safety. For retirees, that cross-market shift matters more than another headline about AI. Next, Michael Oliver reveals why the fourth quarter could expose what markets are already pricing.
Retirement account. You take 20, 30% off that and suddenly he frowns. He and his wife frown. Emotion comes into play. Panic comes into play. That's the situation we're facing. So you got to watch all 4 asset categories. So that's what we do.
Fantastic. Well, Michael, are there any last thoughts you'd like to leave with our viewers? I think we covered the most of the markets here, but definitely if you wanted to leave any last thoughts for our viewers here.
Yeah, I think that what's going to see in the next 6 months is going to be, between now and the year, will be shocking in most markets and shocking to the investment public in terms of why didn't I know that attitude. But the market knew it ahead of time, especially gold and silver. That's why they're doing what they're doing.
I did want to just quote from your recent report here regarding the government debt crisis that really nobody is paying attention to until maybe just recently. You say the government debt crisis and thus government monetary panic dwarfs other, usually falsely, presumed fundamental factors that affect the stock market, gold and silver, etc. The government debt crisis wasn't an issue in the dot-com collapse or in the mortgage crisis. This time, it's the big one, and gold and silver know it. So did you want to expand on that? You just kind of addressed this, but I think it's important to, as you say, pound the table on this one, that this is the big one, and really the public is just starting to recognize this.
Well, we know back at the dot-com top, which was a truth, and there was internet was going to change your life, but it got overpriced. And so when we topped in 2000 and went down through 2002, the S&P lost 50%, but NASDAQ 100 lost 82%. And yet the internet reality was real. In fact, even more so than people touted it to be, okay? And yet it corrected that big. Corrected, you can call it a correction if you want. And it took it like till 2013, I think, for the NASDAQ to even get back to its 2000 high. Okay, but that was dot-com, okay? Excess in a bubble category. Then you have the 2007 to 2009 bear market in stocks, 50+%.
The market can recognize a debt problem long before retirees see it in their account statements. Michael Oliver's argument suggests today's risk is different because government debt sits underneath the entire financial system, unlike earlier bubbles centered on technology or private mortgages. That makes a broad repricing potentially more dangerous for conventional portfolios, built around stocks and bonds. The overlooked signal is not panic itself, but what assets investors choose afterward. Next, Michael Oliver exposes why today's debt problem could behave differently from 2000 and 2008.
Percent drop in the S&P in layers, and it was mortgage-based, private debt, anticipated by the guys in, The Big Short. And then technically finally justified in late 2007-8. They were ahead of the time by a couple of years. Poor guys. Anyway, but that wasn't government debt, it was private debt. And so the Fed came in and did QEs and so forth to help save it. Of course, late in the game, it already collapsed by that point. And now, though, we have something different. We have a nuclear event that's way bigger than private debt. We also have private debt problems as well. Some of the metrics of private debt are as high as they were in 2007 right now, okay? But when you have a government debt crisis and you have doubt, not just in Japan, but now the U.S., two major economic powers of the world, where people doubt the validity and the stability of their paper, you have a total rethink underway. I don't mean a temporary one, but something that could change a lot of things that people don't anticipate. Politics could change. The political parties could bust apart, as they're doing, meaning neither one is a majority party anymore. They almost need third parties to get a majority. Okay, you get my point. Things are happening like that nobody anticipated. And a lot of other things are likely to happen too, because when government debt comes into doubt as to its validity, stability, it's not a place to be. It used to be absolute, totally stable place to put your money. Now it's not perceived that way. Well, what do you do then? And also that brings into doubt fiat money. And I don't just mean the yen or the dollar, which is going to head into demise here very shortly in a way that everybody can notice, but also the euro and the pound. I mean, it's not been forever after all. Fiat currencies are not been around for 300 years.
The next crisis may not need another Lehman moment because sovereign debt itself could become the pressure point. Michael Oliver notes that 2008 centered on private mortgage debt, while today's vulnerability reaches directly into government balance sheets and fiat currencies. That distinction matters because policymakers cannot simply rescue the sovereign without raising questions about the currency funding that rescue. For savers, the definition of safe could change quickly. Next, Michael Oliver exposes why the currency risk extends far beyond the dollar.
They've been around for one long human lifetime, 100 years or so. And every decade, the government debt crisis increases and increases, and we sure shove it out of the way and ignore it. But as Jamie Dimon said some months ago, this time we got a debt crisis, and we're going to have to deal with it. Not going to be able to push it aside for another 10 years. So I think what you're seeing in that miner versus gold spread is not merely a statement that the miners are too cheap to gold, which is true. By the way, same is true with silver versus gold. It is the same technical situation favoring it. But that something much bigger is going on here, and that's merely a reflection in one overlooked asset category that will express upward ventilation because of these factors that we're talking about suddenly coming into people's vision. Like, oh, I hadn't even thought of that. That's a typical ambush that markets inflict on people when they turn. Is after the fact, then the reasons become evident. So this talk about, for instance, war. Heck, we have wars every couple decades. Just go back and look at your history. I don't mean World War II and World War I, but all the wars in between, involving the U.S. even. So that's a constant. So you can't say, well, things are uncertain only now because of the Iran-U.S. war. Yeah, we've had a lot of wars before. That's transient. And ultimately, you'll look back and say, well, that really didn't matter. In fact, if you take a S&P chart or a gold chart and go back to when the war began and draw a line sideways, you'll see it really didn't matter. Yes, there were ups and downs, but it was, there's nothing that really happened pivotal at that point that lasted when the war began. So anyway, but this situation with the financial assets of government is so major that I call it nuclear event.
War headlines can distract investors from the slower threat building underneath sovereign balance sheets. This is where Michael Oliver's thesis shifts toward the debt structure itself, arguing that miners and silver may be early signals of a broader monetary repricing. The critical distinction is between temporary geopolitical volatility and persistent financial deterioration that cannot simply be ignored. For wealth preservation, the hidden risk is mistaking noise for the real structural warning. Next, Michael Oliver reveals why financial assets may already be signaling the ambush.
And I think that this gold spread, the miners versus gold, is simply an indication of the initial asset class panic shift into that which is more stable, safer.
And you've also mentioned how the banking sector has started a fresh downtrend here. Can you expand on that and what it means for the banking system?
Everybody's looking at semiconductors, and we're going to put out a report today on Apple and NVIDIA to update them. And they've got some points of vulnerability right below their feet as well. But we've also been monitoring constantly the XLF, which is the broad financial sector ETF, which includes banks, insurance companies, broker-dealers, etc., and also KBE, which is the banking ETF of the larger banks. And we plot them technically, and they tend to move up and down with the stock market, but to much more anemically. If you go back through history, they're extremely anemic compared to the growth in the S&P, which is at least matched the money supply decay. They haven't. But they have technicals that were triggered last week that were precisely a visual upside down version of what gold and silver broke out through the upside 3 weeks ago, namely a flat ceiling on weekly momentum where gold and silver for 3 months came up to the same ceiling and couldn't get through on momentum, not evident on price. The same was true with XLF and KBE. They kept going down, but they hold this flat support level around the 3-week averages for like almost 3 months. The absolute inverse of what the monetary metals are doing. So the monetary metals broke out 3 weekly bars ago at prices well below where we are now. And last week, finally, the financials and the banks broke below their intermediate momentum trend structures, echoing the same outcome, but inverse, which makes sense. And yet nobody is paying primary attention to financials. It's always AI and so forth. You need to watch the financials, their core. And the same thing happened back in 2007, by the way. You could plot the XLF versus the S&P on a relative basis, a spread chart, in other words, and it broke down in mid-2007, several months before the S&P finally peaked and topped. But the financials warned you that something was wrong inside the market, especially in the financial sector. No, there were no headlines at that point.
The market may be watching Nvidia, while banks quietly flash the more consequential warning. According to Michael Oliver, financial ETFs broke their intermediate momentum structures just as gold and silver broke upward, creating a striking inverse signal. That matters because financials previously weakened before broader market deterioration became obvious. Investors focused on popular technology trades could therefore miss stress emerging beneath the surface. Next, Michael Oliver exposes why the banking signal could arrive before the headlines.
Headlines came later, a year later. But right now we have breakage in the financial sector and the banking sector that is significant enough for us to argue, they're vulnerable for, a good significant downturn, like 10% or so. There's a problem with that. And this is true with the S&P as well, which right now, this week, is dancing on its intermediate trend structure. You get much below today's low on this weekly close on the S&P, and it breaks down just like the financials did last week. It doesn't mean an instant disaster, but it says the intermediate trend is now likely down. There's a problem with that. You cannot afford a modest intermediate decline in the market right now, because if you get one, the long-term momentum factors underlying the S&P, the NASDAQ 100, and the sectors within it is only about 8 to 10% below you. So a lot of the intermediate swings in the market will be of 10% or more in dimension. The problem now is you can't afford that because it will trigger annual momentum of the S&P into major negative category. So we're dancing on glass, is what I'm saying. And I think gold and silver know that. So again, if you start to break the stock market, what are people holding that asset going to do? Well, they're going to start to sell it, and they're going to put the money somewhere else. And if you go back through history, you'll find that major bear markets in the stock market are always inversely matched by rises in gold and quite often T-bonds. But this time, T-bonds won't play that game. It's just gold and monetary metals. So anyway, that's what we're facing. And I think it's the real issue of these big financial issues, not AI, semiconductors, or the Iran thing.
So it seems like
a 10% stock market decline could matter far more today because momentum is already sitting close to a critical threshold. What Michael Oliver is highlighting is that financial sector weakness may be the early fracture, with the S&P potentially following if its intermediate trend breaks. If investors start reducing equities while bonds fail to provide the traditional refuge, capital has fewer defensive destinations. That makes monetary metals unusually important.